Ferrari just lost $23 billion in market value in a single day. Not revenue, not profit. $23 billion wiped out overnight. What triggered it? A single earnings report. If you're an investor or entrepreneur, you need to understand exactly what just happened here. Because this reveals how fast confidence can collapse in the market and why it matters to your business strategy. Here's the cold hard truth. Ferrari's earnings came in below expectations across the board. The luxury automaker, known for exclusivity and premium pricing, reported slower than expected deliveries and warned about market headwinds. But here's what actually spooked investors. Management downgraded their full-year guidance significantly. They're not just saying sales slowed, they're saying they expect it to stay slow and continue deteriorating. Deliveries missed targets by double digits in key segments where they make the most profit. Profit margins compressed harder than any analyst predicted in their models. Most critically, the company signaled they won't hit their aggressive growth targets this year. When a company built on scarcity and prestige announces scarcity isn't selling anymore, panic begins. Within hours, Ferrari's stock price collapsed 15% in trading. $23 billion vanished from the market in less than 24 hours of trading. But here's the dangerous part. This wasn't about Ferrari's fundamentals changing overnight fundamentally. The company didn't suddenly become worthless or lose its production capability or brand power. What changed was investor sentiment and perception of future growth prospects. And in the stock market, sentiment is absolutely everything in determining valuations. Think about it this way. Luxury markets are the first canary in the coal mine for economic health. When wealthy people stop buying $300,000 supercars, it signals massive economic anxiety at the top. If billionaires and ultra-wealthy consumers are tightening their belts and pulling back spending, trouble is coming. That realization spooked institutional investors across the entire luxury goods sector immediately. Within 48 hours, other luxury stocks tanked alongside Ferrari's collapse. LVMH dropped, Richemont dropped, Hermes dropped. The entire luxury market caught the contagion effect. Because investors suddenly realized if Ferrari can't move cars in this economy, what does that signal? What does it tell us about overall consumer spending patterns and economic direction? What does it tell us about recession risk and where we are in the economic cycle? A single earnings miss triggered a cascading sell-off across multiple luxury industries simultaneously. The deeper lesson here is critical. Stock markets aren't rational value machines at all. They're deeply psychological systems driven by fear, greed, and perception of the future. One bad earnings report doesn't destroy $23 billion in real company value overnight. But it destroys $23 billion in perceived value and investor confidence in growth. And in the stock market, perception is reality, and perception drives capital flows. As an entrepreneur, this teaches you something critical about business perception and strategic pivoting. Ferrari's mistake wasn't their cars or manufacturing or product quality at all. Their mistake was overpromising growth and then under-delivering on those promises to investors. That's a killer combination that destroys investor confidence faster than anything else. Most founders focus obsessively on hitting revenue targets and quarterly metrics above all else. But they ignore the narrative they're building and the expectations they're setting with stakeholders. Ferrari built a narrative of unstoppable growth and exclusive controlled scarcity driving values up. Then they signaled that scarcity was becoming a liability rather than an asset to their business model. That broke the narrative completely and shattered investor trust in management's vision. Here's why your messaging matters as much as your actual business metrics and numbers. As you grow, investors and customers buy your story as much as they buy your product. When you signal weakness or struggle, when you miss guidance to market, when you change the narrative, people recalculate everything they thought they knew about you and your company's future potential. That's when capital flees the fastest and investor confidence collapses rapidly. The flip side, if you manage expectations conservatively and beat them consistently, you build resilience. If you communicate clearly about challenges and have a solid plan to address them, you build trust. Ferrari could have minimized this crash by preparing the market proactively for weakness ahead. They could have said, "We expect challenges in Q4, but here's our long-term strategic recovery plan," instead. They surprised investors with negative news and broken promises about future performance. So what's next for Ferrari and the broader luxury market in the coming quarters? Ferrari will recover eventually. They're too iconic and established not to bounce back over time. But this signals a broader market cooling in luxury goods and high-end consumer spending overall. Expect consolidation in this sector as weaker players get absorbed or fail in this environment. Expect more correction in luxury stocks before the market stabilizes and finds new equilibrium. For you as an entrepreneur, remember that confidence is currency in business and in capital markets. One earnings miss, one broken promise, one negative surprise can undo years of built credibility. Don't let that be you. Manage expectations, communicate proactively, and execute consistently on promises. Subscribe for more deep dives on how top founders navigate market crashes and come out stronger. Comment below.